So coming in from Realtor.com, guys, we had housing sentiment is at the highest level in nearly 2 years, Fannie Mae says, because of home sellers. Home sellers are feeling a lot more optimistic about the housing market, according to a new Fannie Mae survey ahead of the spring home buying season. In February, the home purchase sentiment index by the government-sponsored enterprise rose for the third month in a row to 72.8, and that's the highest it's been since March of 2022.
Yeah, I believe that.
So it says consumers' attitudes towards home selling conditions increased markedly in February. So I feel like we said sellers finally hit that point where they're like, yo, I either need to really sell or, yo, I need to get out of this because my situation doesn't, fit anymore. I was out voting last week, and I was speaking to one of the people that was voting, and we got to talking. He asked me, hey, what do you do? I told him, oh, I'm in mortgages. He's like, hey, I just refinanced. I'm like, oh, wait, what?
Great.
I was going to say great. I was like, great. But then I was like, you refinance? I was like, what? Like, it doesn't make sense. He's like, we had a lot of debt. He's like, we had a lot of debt. So I was like, interesting that you brought that. He's like, yeah, like I didn't want to, but we had over like $200,000 in debt. We had to basically wipe all that out, and we refinanced. My rate went up to 5%. But his biggest thing was like, I didn't want to be drowning in debt. And that was one of the biggest things that I took away from that. He was a regular working man. He works. He was actually working on the Gaylord construction down here on the bay. So he had just got off of work, and he's like, yo, like, I'm not making the money that you're seeing out in the economy, So he's like, my bills are tight. My dollar's not stretching as far as it used to. I had to make this decision because I was drowning in debt. Dude, go back to 2016. His house had just burnt down.
Oh, shoot. Okay, this is a great scenario because that's not common for people. But people think, oh, that's stupid. Why would anybody do that? For that reason.
His house completely burned down. He said it burnt down to the freaking ashes here in Chula Vista area. And he said thankfully he had insurance.
Yeah, of course.
Thankfully, had insurance.
Everything was available.
Everything got, constructed back up, and it went good. Apparently he got a little bit more, but I won't say that. But the biggest thing was that he leveraged his property to get out of a huge issue that he was in, over $200,000 in debt, and now he was able to consolidate it all under his mortgage, 5% rate, and I think his payment was still like under like $3,500.
Yeah,
because they had the house like fairly paid down. So, I mean, that right there just goes to show that, there's going to be situations, there's going to be like life-changing situations that you have no control over. But if you have a house, you have a hard backstop, you have a really good savings account that you can tap into and replenish it. It's just, how you really put it down into perspective and how it plays out. Like you brought up a really good example with your client, how you're helping them basically shift around all their stuff. But it makes sense for them, even though they're going from a 2% rate to a higher rate.
Exactly.
The way that you're structuring their finances and their monthly payments, it makes so much sense because they're actually saving money, even with the higher rate. And that's what people don't understand and don't want to listen to because, it's going to be more. No. Break the numbers down, do the math, see it for what it is, and you're going to realize, like, the math does math.
Just reinvest into yourself too, right?
Reinvest into yourself, 100%.
It's not always about the rate. I mean, that's the primary example. It's not always about the rate. I mean, they lost their home in a fire. They had to get the house rebuilt. Now they got all this debt for whatever the other reasons were. And financially, look, I wrote this here. The home is doing the heavy lifting. And we've talked about this before. That people are going to get creative. Banks are getting creative. Agencies and government, local stuff is getting creative to help out and ease some burden in housing. And people are going to have to make some hard choices. And maybe in this case, it wasn't that hard. It might have been easy to go, I'll just take the refinance because I need this debt off my back.
Yeah.
Well, here's the thing. We are sitting on this is the most equity anybody has ever had.
Ever.
So normally when you purchase a home, you just purchase a home because you don't want to deal with the increase in rent or getting kicked out of your home. You just want that dream of home ownership, so you do it. We never imagined we'd have a ton of equity the way we've been building it these last years,
Yeah.
And so when you're having that equity, we miss that. Thankfully, we have that there. So we're able to leverage it, And so like Brian was saying, we have a client that has $9,000 in change worth of debt. I'm consolidating everything into one. His new payment is going to be like $5,600, which is going to save him it was like $3,400.
Wait. You're saying the $9,000 was monthly out-of-pocket expenses?
Yes.
Out of pocket.
Yes, that's what I'm saying.
Oh, wait. Okay, I'm sorry. I didn't know this.
Yeah, so we're actually taking $195,000 paying off debt. That's a total of $5,800 monthly.
Whoa.
Right? And with his mortgage of 33 because he's got a great rate, 2 point and change. I'm not a big fan of it, but when I do the numbers, this is where the mortgage accelerator calculator came into place again, you know, which we love.
Ooh.
I taught him how to reinvest in that. It's going to take him 6 years to get back to where he's at today.
Wow.
You know, by putting $1,200 on every month
Oh,
towards his
extra.
principal. Yes.
Okay.
From that 33 that he's already saving, put $1,200.
Wow.
And then you're going to send a $2,000 extra payment annually.
Wow.
And that put him back. You know, it was 7 years.
And wiping out $194,000 of
that
debt.
was going to bring him, because his balance is 588. We're going to do a new loan at 800.
Yeah. Yeah.
So
Okay.
in the 7 years, if he follows that
right back.
formula, that's it. He'll be
Dang.
under that.
That's crazy.
And that's right now at a 6.25, because it's a larger loan.
Right.
You know, so once we refinance later down the line,
You're
those
talking
numbers
about-
will change.
Dang.
So it's just leverage at its best. You
Yeah.
just got to learn how to use these tools
Yeah.
that you have that are
Yeah.
available, you know?
Yeah. Yeah.
And I mean, consumers aren't, dropping their credit limits anytime soon.
Yeah.
I mean,
No.
we went from
Yeah.
what, 1 billion
Yeah.
to 9 billion. Remember I sent you that message?
Yeah.
I was like, Andy, am I understanding this correctly? Like, is this information
Consumer
I'm reading
spending?
true? Because I'm like, they went from 1 billion to 9 billion. I'm like, that's
Yeah.
almost a 10x
crazy.
increase, bro.
Yeah.
Like, I'm like,
Yeah.
what?
I still
Yeah.
have to look into that because it has to include something it didn't before.
Yeah.
There's no way it went
What-
900% higher
Like,
just
what
in 1
just
month.
throws me off is that, like,
Because that's not reflected anywhere else in the economy. by the way.
I'm
It's
like,
just that
yo,
one
like,
figure.
hey, yo, is anybody else seeing this?
Well, we already
Yeah.
saw these credit scores are at its biggest decline.
Yeah.
You know, credit scores.
Yeah.
And now we're at that $1.13 trillion in debt, credit
Yeah.
card debt. It's crazy.
Yeah, and growing.
And growing.